guys and girls, welcome back to another BMO video. Today we're going to be looking at the top-down fundamental to technical analysis. So essentially, how do you get a fundamental bias to then how do you apply that to your technicals on your charts? Now, applying it to technicals is very, very simple. You'll see that as when we move on to the technical part. It's just getting that fundamental biases pretty difficult, and it does take a lot of work. So don't get me wrong, you're probably going to watch this video and be a little bit confused at the start, but that's why we've made all the videos below this one in regard to what's GDP and what's the inflation and what is a bond market. So we've covered pretty much everything you need to do, and of course we are always updating that as we go along and as we learn newer and newer stuff. So firstly, let's run straight through into it. So fundamentals first, technicals second. This is really, really important. This is actually pretty counter to what everybody else has taught. So everybody else has taught sort of do your technical analysis, fundamentals doesn't really matter. But in reality, it's actually completely opposite to that. You know, if you read all the fundamental docs, when we get the guests on, they all talk about fundamentals. Nobody mentions technicals, even from just noticing something. Clearly that does tell you something that you need to learn fundamentals, right? So remember, fundamentals gives you the direction, gives you the trade ideas. Technicals is just a way of entering the trade and a way of seeing how much risk you're doing. So essentially how big's your stop loss essentially. So firstly, contrary to what you've been taught, fundamentals are one of the most important aspects of your trading career. It is applicable for shorter term and longer term horizon traders. The reason why it isn't taught is that it's difficult. A lot of people aren't willing to do it, and people want quick fixes. As we know, people come into this, into trading, right? Like I've mentioned here, if you treat your trading like a career or like a business, you'll see the results. And if you treat it like a side hobby or a hustle, you're good luck. That's all we can say, because you are not going to see results if you just treat it like a side hustle or a side hobby and say, I'll come back to it every now and again. Yeah, it's all good. Yeah, you don't want to treat it like that. You need to go all in with this, and you will see the results, trust me. So if you treat it like a business, think of yourself as a business. I'm not sure how many people own businesses here, but of course, when you run a business, you need to always just continue to expand your knowledge, try something new. So this is something new for you, and trust me, it's really, really difficult. You don't need good grades to do this stuff. I got a C in English. I got a B in maths. You don't need to be smart. You don't need to study finance. You don't need to study econ. Of course, that will help, but it's just not a necessity. So, yeah, like I mentioned, you don't need to be really, 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 really smart to do this. You just need to want to do the work, and it is a lot of work, trust me. But if you're here today, you are going to learn a lot of stuff, and a lot of stuff that's not taught. So that's good to know. No wonder a lot of people lose money when they're neglecting one of the most important aspects of trading, which is, of course, fundamentals. Don't worry, fundamentals become a lot easier once you've learnt the basics. So GDP, interest rates, inflation, and also I've added on there some monetary policy. It may seem difficult at the start, but if you stick with it, it will become a lot easier, I promise you. Think about it when you started trading, you learned your technicals, or you started to learn it. How difficult was that? It was pretty difficult, don't get me wrong, because it was something completely brand new. You've never done this before. There's a lot of information out there, and it was difficult. Now, as you were just doing it, getting into the gist of things, it became a lot easier. It's exactly the same thing for fundamentals. It's just a much steeper learning curve. But like I've mentioned, the moment you start learning this stuff, the more you want to learn it. So it's a win-win. In this PowerPoint, you'll learn how to get your fundamental bias and how technicals are applied to this. Trust me, it's a lot easier than you probably are thinking. It's just getting that fundamental bias is a little bit more on the trickier side. Remember, technicals reflect what has already happened from a fundamental perspective. A chart doesn't move because a line or a box says it must. That's really, really important. Like I mentioned, a lot of people put a lot of emphasis on technicals, but just because you've drawn a line or an order block or a resistance point, it doesn't mean it has to respect that, right? There's something happening behind the scenes that everybody's missing, and it is this fundamental perspective. Technicals is just a way of reflecting entry and risk, but directional bias comes from understanding the economic side. Banks aren't out to get you, as we are simply not worth it, as they learn earn money in other aspects of the bank. So this is another sort of thing I've noticed on, especially on Instagram. A lot of people like to blame the banks, stop hunting them and taking them out. Trust me, they don't really care about us. We're just not worth it in terms of liquidity. So they trade completely different to us on how we do it. But in terms of getting the trade idea, remember, not every single trader at a bank is a market maker, which means they're not able to, in quotations, take you out. You know, the traders, the discretionary traders at the banks, market making is a small component of the bank, right? Not every single bank is a market maker. Not every single trader is a market maker. So all you got to think about is, okay, so if not every single trader is a market maker, what else? What else are they doing? So the actual traders, what are they doing? That's what we're very focused on, and that's what we're interested. So if you learn fundamentals, you should have an idea where the technical chart should be on a 1 month, a 3 month, or a 6 month horizon. From then on, your trading becomes a lot easier and less stressful due to not guessing where a chart will go. This is really important because if you're technically just drawing lines on the chart, you obviously have done your back testing, fine, but you don't have that deeper understanding why that should happen. The question you have to ask yourself is why? Why is this going to happen? You can't say, oh, because it's broken structure, it's pulling back now, let me long it. That's not a reason. So you need that reason, and the fundamentals gives you that reason. So fundamental views. So have your overall view and then have your tactical view. So firstly, let's start off with what's your overall view. So this is just simply what the longer term currency view is. So where should euro dollar be on a 3 to 6 month horizon? Do the markets or you think the currency should be higher than where we are now on a 6 to 12 month horizon? And think about the timing aspect as well. If you believe that the dollar should be higher, but we are trading at the lows, the timing is likely wrong for you to get in. Markets may have gone tactically short the dollar for a reason. Find that reason. And as I've mentioned, as you may have seen, just flicking through the course content, tactical trades, I've made a video on that. So we'll get into that in this later video. I've quoted it there. But you've done all your fundamental reasoning and you say, okay, based on this metric, Aussie US dollar should be higher. But we're trading all the way lower and lower and lower and lower and lower. And you're like, okay, well, one, you might not be wrong. It's just probably based on your timing. So if the markets do feel like Aussie US dollar should be higher, but we're trading lower, it's not because you've done everything wrong. It's just a matter of the timing aspect. So like I mentioned, they may have gone tactically short based on, let's say, Aussie US dollar shorts might have been because of China weakening very aggressively. So they will go short Aussie dollar based on that metric because the trade relationship between Australia and China. So that's a tactical reason for the markets to go from being long to then now, let's quickly go short in the most immediate term. How we time the long-term view is to look at what's driving it lower. Then simply look at seeing a shift in the sentiment back up to the upside. So watch the data, watch commentary from central banks, watch external factors. Like I mentioned, that China component, and there's a lot more to that. Now, a tactical view is simply a view that is recently popped up or battles your longer-term view. For example, if China slows down aggressively, the markets may go short the AUD in the near term, even though they may fundamentally be long. So that's the example I've just given you. Watch any shifts in your reasonings. The markets move based on the direction of the shift. If data was so good for so long and we start to see a slowdown in the data, do you think the markets will continue to be long? That's the question you have to ask yourself. And the answer is no, probably not. There's no definitive answer in sort of trading, but based on what we know logically, probably not. So the prime example is look at the US and the USD sort of from around October onwards, October, November. We saw that shift higher. We saw that massive shift higher on sort of July, August, September-ish time, 2023. We're then now seeing a massive shift lower is because we had all the positivity in the data. We then now start to see cracks in that data, which markets saw reasonings to shift their view, and then they went short. So that's just an example or a live example of the markets switching their bias. But I've made videos on that, of course. And a video has been made on these two views, and it's called short and long-term themes. So that's just a way of understanding sort of what's a tactical play, how do you define that? What's an overall play, or what's a fundamental play? How do we define that as well? So firstly, how to get a long-term fundamental view. Here is a step-by-step way of getting your long-term fundamental view. I don't expect you to get this first time. You do have to really do a lot of back testing on this. But I've given you a way of also back testing in sort of later on in the slides. But for now, think about what is the global theme. So what is everyone talking about? So based on the news, based on kind of how the market's reacting, so the reaction function, I have made a video on that. Based on what the people in the docs, the analysts in the docs are saying, that's kind of what the theme is. And for example, 2022 was all about who is hiking aggressively. And the 2024 theme, that sort of 2022 theme did bleed through into 2023 as well. But that 2024 theme is now likely to be who's cutting first and more aggressively. So now we know kind of what data supports this theme. So I've mentioned, then think about which data supports this theme. So what supports the idea of who's going to cut first, who's going to cut more aggressively. So for example, if the markets are talking about growth fears, you now know what data will be at focus for the markets. Follow the 3 simple indicators, which are, of course, GDP, inflation, and interest rates. Drew has made a video on this that is just below this video. And all other data adds to these data. So if you have the basics nailed down, you're already halfway there. So that you need to really put a lot of work into the GDP, put a lot of work into inflation. What drives inflation? What creates inflation? How do you deal with inflation? What are interest rates? Why are interest rates risen? What drives interest rates lower? So you need to have a top-down view on the GDP, top-down view on inflation, top-down view on interest rates. Once you understand the really basic stuff, everything adds. All the other stuff just adds to this narrative, adds to this. All the other data adds to either inflation, adds to either interest rate expectations, or adds to GDP as well. So if you are following everything together, you should be in tune with what's driving the markets. So if markets care about cutting expectations, for example, which is a big theme for us next year, I'm recording this in December 23. If you want to follow data that would suggest if cutting will increase or decrease, inflation data will be key in this respect. Remember, the only reason, or one of the main reasons why a central bank raises rates is because of inflation anyway. If inflation is moving high, they obviously want to raise rates to restrict spending, restrict borrowing, because again, if you're at really low rates, that does, support inflation higher because it's cheap money, right? So if inflation is moving up, or if inflation is moving down in this example here, what do you think is going to happen next? Well, inflation is moving lower. Central bank isn't going to keep, their interest rates high just because inflation is moving lower. They are going to be more dovish, so you're more likely to be a bit more weaker or a bit more bearish on that currency. Now, other thing I'm talking about today, you might be a bit confused if you're brand new to fundamentals, because obviously this is the first video in the fundamental section. But I'm just showing you how to apply this. Everything below that will add to this video today. So everything I'm talking about inflation, when I'm talking about the bond market, I have made videos on all of that below this, but I'm just giving you a good sort of framework to work with. Again, everyone will have their own way of doing it. Some people will prefer to do it on an Excel spreadsheet. You can do that, absolutely. There's no right or wrong answer in the way you do this. It's just what you prefer to do. So if you like to write on a Word document, or if you don't like to write anything on a Word document and you just want to, just always look at the data, always looking on Trade and Economics, which is a website we're going to be talking about today, that's essentially the same thing. Some people like to memorize it better by just looking at something. Some people like to memorize it better by writing it down. Everyone is different. You can then also do some cross-asset correlations, like currency moves versus the bond market moves. So again, a video has been made on this called the 3 pillars to FX. Look at positioning data as well. So COT data, some of you may know about that, just to see how stretched is the market in terms of orders. So how stretched is the US market, for example? That would give you an idea about the reaction function as well, which I have made a video on. It's important to broaden your knowledge of the entire market. FX markets are interlinked with pretty much everything, so learning a bit about those markets wouldn't hurt. I'm talking about like the bond market, for example. So a lot of technical traders don't even know what the bond market is, when in reality, it's probably one of the most important markets for FX. It's one of the main drivers, actually. So if you're not learning about a very, very important aspect of the market, you're taking out a huge chunk of what's really important. So yeah, learning about the bond market wouldn't hurt. Learning about the equities market, you don't need to be, the ins and outs of all of the market. You just need to know what drives it, what's happening in that market at the moment. If you want to learn everything about it, fine, absolutely. But in terms of like an FX correlation perspective, you don't need to know everything about it. You don't need to know about margin compression in stocks or on balance sheets, which obviously impacts stocks. Again, it's you just know kind of what drives that market, what's happening within that market, what's the sentiment, etc. within that market. So follow these 3 simple components. So I'm sure you could have obviously guessed that already. GDP. So GDP is simply a figure that shows the overall growth within the economy. There are many subcomponents of GDP, and you need to understand these. Drew has made a video on that. It's one of the first videos, I believe it's the second one. Value first, how to understand value, and then of course GDP. So Drew has made videos on the components of GDP anyway. Inflation. Inflation is just simply the change in prices of goods and services. If inflation rises, central bank may need to be more hawkish to try and bring inflation lower. Again, very self-explanatory. Drew has also made a video on inflation. And of course, interest rates. This is just simply the cost of borrowing. A lot of things you may have experienced have risen because of higher interest rates. It could be as simple as a phone contract or a credit card increase in the way how much you pay back, for example. So I know for my I have a SIM only contract, so I paid just for the SIM. That has increased. I used to actually get a really good deal. I think it was like £23 with EE. I used to, 200 gigs of data, unlimited calls and texts, Apple Music, and something else for 23. Now I'm paying over 30. So that's just an example of it rising with higher interest rates. So that's just a very, very 3 simple components for you to learn. Like I've mentioned, all the data that comes across that we see adds to these 3 sort of components. So if you understand this stuff, really, really important, don't move until the advanced stuff without understanding this stuff, please, because you will confuse yourself. So learn about what's GDP, everything you need to know about GDP, everything you need to know about inflation, everything you need to know about interest rates. And like I've mentioned, everything else after that just adds to this. So if you understand this first, everything else will become a lot easier, trust me. So don't learn about the bond market if you don't know what drives or what's interest rates, right? Because they all interlink with each other. Don't learn about equities markets if you're not understanding kind of what's happening with inflation, of course. So you need to know about these 3 components first. And a little special note for you is to follow the direction of the data. So watch the direction of data surprises video. That's really, really important. Very, very sort of key components of what we're seeing over the last sort of 2 quarters, if we will. GDP. Start by using the 3 website, tradeandeconomics.com, to get your data. Click countries, then the country you want to view. You can also use Forex Factory if you wish, but it may take you a little longer to find the data. For example, if you want to use Forex Factory, you are going to have to go into the settings and remove all the other countries, and then go into whatever country you want to look at, and then GDP. And you might have to scroll back as well. Trade Economics is good because it gives you kind of everything you need to know. To be fair to you, fundamentally, right? Everything is there that you need to have and you need to know. So it's a really good free website. But everybody has their own, you might use another website. As long as you get the data, that's the most important thing. You can input the data onto a spreadsheet or write it down in Word, for example. But like I've mentioned, if everyone will do it slightly differently. There is no right and wrong answer here. But if you're keeping up to date with data, with what's driving the markets, it may not necessarily have it visually, but you can, of course, do it if it helps you to see it better. What I mean by that is if you're always watching the news, or not necessarily like watching standard news, but always keeping up to date with the data, always keeping up to date with what's happening, then you don't really need to do that. But like I've mentioned, if you feel like you need it visually because you learn it that way, because everyone does learn slightly differently, absolutely fine. Please do that. But this is, of course, UK GDP. This is just the direction of that data over the last sort of few prints there. Then think about the trend of the data we have seen recently. Ask yourself, how does this support the theme? Again, like I mentioned, the theme gives you a good framework to work with what data to consider, because there's so much data. You're probably thinking, what data do I even watch? So as long as you know what the theme is, like the overallistic market theme. There are going to be sub themes within the economy. For example, like an election is a near-term theme, or something happens within the economy very abruptly. That could be a theme, for example. But in terms of like the overall market theme, we know that at the moment the market's theme is about who's cutting first. So now we just need to watch data that will support the cutting first theme. That is it. And then after that, it might be something else. And after that, it will be something else. And that's how we just keep up to date with what's important. There's a difference between, I heard this, I think it was LinkedIn actually, about there's a difference between tradable macro and macro. So what they meant by that was macro, so meaning macroeconomics, everything, looking at all that, and then how does that apply to trading, the tradable macro? There's a difference there. Economists will look at absolutely everything. Traders will look at certain bits that applies to their trading and to what drives the markets, right? So again, you probably, there is a lot of data, but all you're doing is just keeping up to date with what will drive that theme that the markets really care about. Now, if GDP is trending lower, central banks may be more on the dovish side as they need to try and support the economy. But then we would need to see, if inflation trends lower also. You will likely have a bit more of a bearish view on the currency as a result. So if GDP is coming lower, inflation may be also printing lower as well, potentially. And again, you're not probably going to be long the currency in that sort of environment on the margin. So what we mean by that is, if there is a currency view that just or just represented just that currency view, then fine, you would be a bit more bearish, but we know the trading doesn't work like that. So we need to, for example, GDP and inflation might be trending lower in everywhere. So which trade do you choose? That's when we look at sort of an edge to the market. But we've made videos on that, no problem. It's important to note that even though the trend in the UK's GDP has pointed lower, you may be long the pound against another currency, so do the same process for the other side of the trade. Remember, you're trading GBP versus somebody else. So you're trading GBP versus the US dollar, the US economy. So technically what you're doing actually is trading the UK economy versus the US economy. You're not trading the currency, you're trading the economic views, right? What's happening economically. So if you're trading now US economy versus the Canadian economy, all you're doing there is figuring out who is better, who is the better edge. That will tell you which direction. Remember, you need to have your currency direction before even looking at a technical chart. Because if you do your technicals first, you're going to get blinded what's the word? You're going to come very one-sided. So if you do your fundamentals first, that will tell you, okay, based on everything, I need to now be short this currency pair. Okay, I only want to look for shorts on that pair. That removes all of the guesswork out of your trades. Markets need drivers, understanding the driver of the market, but also understanding that there could be localized drivers as well. Like I've mentioned, an election within the government can be a near-term driver. So the UK and the US has elections next year, which is an example of probably a near-term driver once we eventually get there. Write down if recent data is supportive of the theme or not. We aren't going to go over every bit of data today for you to look at, as we have made videos in this, But the thought process remains the same. How does the data support the theme, and what's the recent trend of this data? Learning components of GDP is key. Drew has covered this in the beginner's fundamentals. So again, think about the direction of the data recently. How does it support the theme? What are the components of that GDP? But like I've mentioned, Drew has made a video on this. Now let's move on to the next one, which is of course inflation. Next, we look at inflation data. This is important for central banks, as the very reason they raise rates is to combat inflationary pressures. As you might have seen in our videos, if inflation is surprising to the upside, this may be coupled with a stronger currency due to the central bank taking a more hawkish footing and potentially raising rates again. So again, CPI is very, very important component to your trading. Understanding inflation is key because it will allow you to understand how the central bank will likely react to this, and therefore, how does the currency react? That's very important. It's important to understand the drivers of inflation within the economy. We don't expect you to understand it first time you're doing this analysis, but if you're consistent with your learning curve, you will see the results. In the UK, for example, inflationary pressures mainly come from the services sector. You can look at data that may suggest what inflation is like within the services sector. So you obviously look at the CPI in general. You look at the components of CPI, so what's driving CPI or inflation, and then also other data that support CPI. So for example here, the prices component of services PMIs, because we know the UK is services based. So we want to focus more on services data. And if we're looking at inflationary data in particular, we want to look at what data would support that idea of inflation. So now we look at, okay, PMI data, there's a price component within PMI that is adding to potential inflationary pressures. Okay, let's look at that. What's that up to at the moment? But I have made a video on that, just known as Purchasing Managers Index, PMI. So again, this is the first video you're probably going to be watching as you join us. It may seem very, very confusing at the start. I completely understand it. Trust me, I was exactly the same. I'm not exactly smart. All I got used to is just looking at everything added together, right? And it's the more you do it, the easier it becomes. It's as simple as that. Labour market data also contributes to inflationary data. If fewer people are employed, you may see lower inflation as the demand for goods and services naturally decreases. Again, it all adds to the key three drivers, or the three key drivers: GDP, inflation, and interest rates. So all you're doing now is labour market data is weakening. Okay, so that means potentially less inflationary pressures, therefore less need for interest rates. Therefore, you might have a bit of a bearish currency view on the margin. Of course, that's when you have to add everything else together. But if you're just looking at that, yes, you'll probably likely have a bit more of a bearish sort of view on that currency. You have to do outside research to be successful in understanding fundamentals. Like, for example, why is inflation in the UK different to inflation in Europe? You will naturally pick this up as you move on your journey. For example, I always have Bloomberg TV on in the background. Sometimes they talk about stuff that I've never known before. And now I've learned something. So again, we're going to cover as much as we can in terms of the application of fundamentals, how you get your biases, what data is to look at, etc. But there are going to be very, very nuanced stuff. Like in this example, why is inflation in the UK different to the inflation in Europe? We're not going to make a video on that, but you can just simply go out and research why that is. Now, moving on to interest rates. So obviously this is from Trading Economics, as I mentioned, that free website. It's really, really good. This is them. So the phrasing is they take the stairs up, the elevator down. So obviously I've dotted this out, but they take the elevator down. So very aggressive cuts, right? So it looks like steps, step, and then elevator down. So if you go on Trading Economics, you'll see what I mean. Back in like 2008, sort of before that as well, in the early 2000s, when a dot-com crash, you saw all of those rates and then really aggressive cuts. Now, interest rates lag with what data is doing. Understanding the data now will allow you to understand where interest rates will likely be in the future. Remember, central banks react to the data that we're seeing. If we're seeing data supports another hike, then you could probably, logically state that interest rates will likely rise again, or raise rates for the first time. And therefore, you might be a bit more bullish on that currency if they are raising rates. And of course, bearish on that currency if they are cutting rates, which is why next year is going to be really, really important, because everybody else will be cutting rates. So pretty much almost everybody. So the US, the UK, Europe, Canada, etc. So now us as traders, we have to think about, okay, where's my edge? And it might be from growth data. So it might be growth in the UK is better than Europe. So you're going to be a lot more likely bearish Euro GBP, for example. Or Australia's growth data, even though they're cutting, is slightly better than Canada. So you're going to be more bullish AUD CAD, for example. And then you could look at cross asset, but again, that's all much, much later. Central banks react to inflation data when adjusting policy levers like interest rates, and will also react if we are seeing a lot of weakness in the labour market. As you've learned in the videos, currencies are closely linked with interest rates and bonds in general. The markets are very reactionary. What drives interest rates lower will help you understand how weak the currency could get. For example, if the currency is fairly elevated at the moment and we start to see a very, very sharp downturn in the labour market and inflation moves lower, you could probably logically state there that the currency will weaken fairly aggressively. So this is just understanding sort of the fundamental perspective of price targets, but I have made videos on this. Anyway, 3 pillars to FX is the cross asset correlation, and also price targets with cross assets as well. So HSBC uses this a lot, so does Goldman, and pretty much everybody actually, to be fair to you, because it's very, very important. Eventually, the markets won't care about interest rates. So this is going to be another theme that will likely develop next year, potentially 2025 as well, when all the central banks have done cutting rates. Now they are going to hold rates. We have to now question and say, what is the next theme of the market? We'll only know once we get there, but trade based on what you know at the moment. So the prime example of that is, as I mentioned, I am recording this in December 23, so you could probably come back to this if you're watching this like a year later. But everybody was talking about the soft landing scenario at the moment. Soft landing versus hard landing scenario. At the moment, the markets are reacting to the soft landing scenario. Now, people have their own views about the recession in the US. Is a recession going to happen? Nobody really knows. You could gauge it. Delinquencies are really high. Credit card debt is extremely high. People are struggling to pay back their car payments. This is all sort of indicative of a recession. Fine, I completely agree with that. But if you traded that idea, you would have lost a very large chunk of your trading account. So we know the US dollar is very, very low at the moment in December 2023. So if you were buying it because of a recession fear and a hard landing, right? The dollar rallies in a risk-off environment, you would have lost a lot of money. You would have sort of sold GU, would have got taken out, sold euro dollar, got taken out, sold Aussie dollar, US dollar, got taken out. So trade based on what you know at the moment. Have your idea in the back of your mind. So like I mentioned, the recession in the US, that's fine. That's definitely something for us to monitor, but it's not the market driver at the moment. Markets have that in the back of the mind, but they're not trading that because it hasn't bled through into data yet. The moment it starts bleeding through into data, recession fears, fine, then we can trade that. But we're not going to trade it because it's not materialized yet. That's very, very important. If interest rate expectations are rising due to data suggesting they need to be raised, you may continue to be long the currency given that there is no economic weakness. So we know a good example of that. Again, I'll try and add on as many examples. Pound and Europe as well. So sort of during 2022 is a good example of that, where ECB was raising rates, so was the Bank of England. The currency weakened. So again weakened against certain currencies. It rallied against others, of course, because again that's just fundamental divergences. But the currency weakened, and they've raised rates. That should be bullish for the currency, not necessarily because the economic data wasn't really suggesting. In terms of labor market data anyway, wasn't really suggesting it. So again, that's just an example of, even though rates have been risen, you can also have a bearish currency view on that. Maybe because, as we know, on the margin, raising rates applies more pressure on the labor market, and more pressure on people's pockets, of course. So if the economy is already weak, that's just going to apply more pressure to the downside on their pockets, and therefore growth is likely to remain weak. That's why that's why the markets go weak, go bearish, not because it's downtrending. Remember, or not because the chart is downtrending, or not because it's breaking structure. There's a reason why markets break structure. There's a reason why markets do pullbacks. There's a reason why markets trend the market to the upside, trend the market to the downside. It's not because it's hitting this order block, or it's hitting this support level, or it's hitting this whole number. That is just ways of you getting into a trade. It's not a way of you determining where the trade will go. So you need to try and get that sort of drilled into your head. Not rudely, of course, but I'm talking about how, based on what everybody's learned previously, it's completely different now to how markets, we want to be the people that changes the way the markets, the way retail traders work now, because everyone puts so much emphasis onto technicals. And there's no wonder people laugh and the traders laugh. When we speak to them, there's no reason why there's a reason why they laugh, right? Why there's no wonder why people lose is what they say. It's because they're not looking at the most important aspect, which is the fundamentals. Markets care about what the next interest rate will be. After hiking rates, markets then care about cutting rather than how long they will hold for. All we do is watch data that would suggest when and how aggressive the cutting rates would be. More data suggesting early cuts will likely weaken the currency further. For example, the US economy at the moment is in the soft landing camp, or suspected soft landing camp at the moment, because the data does suggest that. The markets have priced in a lot of cuts for that because, again, soft landing is inflation moving lower, but it's not recessionary. Now, that's good that's good for risk appetite because if there's non-recession or there is no recession, that's pretty positive. The growth data in the US is good at the moment. Cool. But inflation is moving lower, which is kind of the main reason why they would cut rates is because of inflation. So if inflation is moving lower, the market's like, okay, why would the Fed hold their rates this high for this long? They're not. So let's price it in, for example. Now, let's just move on to another one, which is, of course, monetary policy. This is the Bank of England, by the way, in the City of London. But based on what we have just spoken about, so these three interest rates, the CPI components, so CPI's moved lower recently, and GDP as well, kind of printing lower. This is the first quarter over quarter of negative GDP, by the way, in the UK. The second quarter, so 2 negative quarters of GDP is recession. Well, that's the textbook view of a recession. So based on what we've just learned, do you think the Bank of England will likely be more dovish or hawkish in the future? So I just want you to think about that. Of course, you will have to look at other data like PMIs, but the gilt markets, the bond market. But based on just the inflation and GDP stance, what do you think will likely happen? So we've seen the trend lower in inflation. We've seen the trend lower in GDP. They are more likely to be dovish as a result, which means as a result, for the interest rate sensitive pound, we want to be more bearish on the currency. The central bank will react to recent data we have just seen since the last meeting. This doesn't mean selling every single GBP XXX trade. Do the same work for each economy. When comparing central bank rhetoric, you want to be more long the currency that's slightly more hawkish against the other that's more dovish. So, for example, if the Fed is more dovish than the Bank of England, based on sort of central bank rhetoric, GBP USD upside makes more sense. So that's just an example of sort of comparing that sort of framework there. There are going to be instances where both central banks are dovish or hawkish, which is when you turn your attention to data, etc., for clues on who to buy. So data, for example, the UK or the US might have better growth data at the time than the UK, or there might be another edge, for example, oil prices or gas prices are extremely high in Europe. When obviously Europe imports a very, very large amount of both oil and gas, that's going to create a bit more of an issue for Europe. So therefore, you're going to be likely a bit more bearish euro dollar, for example. So there are going to be instances where there's going to be edges. You can also look at the data. That's really important as well. And then you're going to find your view. If there isn't many, then just don't trade it. As simple as that. You know, there are going to be a multitude of different trades out there for you. You don't have to trade every single pair. That's really important. Don't force a trade or don't force a pair if something isn't there. That rhymed, but I didn't mean that to. A central bank will tend to have a dual mandate. So a dual mandate is price stability, so inflation stability essentially, so managing inflation, and maximum employment. Other central banks may have different mandates, so it's important to see what the mandate is for each bank. But generally, they'll have inflation stability, or known as price stability, and maximum employment. The central bank will adjust monetary levers, like bond purchases or interest rates, to balance the two. They will put a little more emphasis on price stability first before considering employment. What we mean by that, for example, a good example is what we've seen with the Fed recently. So the last meeting of the Fed, they were pretty dovish. It's because we saw evidence of more lower inflation, even though the labor market's still pretty good and still pretty tight. They did obviously mention that. The fact that they turned more dovish is mainly because of inflation. So that's just an example of inflation's moved lower. Cool. Eventually, inflation's moved to their target of 2%. Now the markets, or now the Fed or the central bank will turn their view to what is the labor market doing? Is there any support that we need to do for the labor market, for example? This is why, even though the labor market data is in the specific country might be pretty good, if inflation is falling rapidly, the markets may be a little bearish in the currency in the near term due to the need for lower rates quickly. Look at the US example look at the US, for example, in late 2023. So obviously, basically now is a prime example of that, where inflation is trending lower, even though the labor market's still good. Now, you might think, that we should be bullish the dollar in that sort of perspective. Not necessarily, because, again, the theme of the market is who's going to cut first. If inflation is moving very rapidly lower in the US, or pretty quickly, relative to the consensus, so it prints lower than consensus, basically, that tells the market that the Fed probably needs to be a bit more dovish quicker, and they've priced in more cuts and therefore lower currencies. So eventually that will change. It's a given that will change. It's just a matter of when. Again, we'll look at the reaction function, the data, etc. We have noticed that markets will see what the central banks have said and the data going forward until the next meeting to support the narrative. If the data doesn't support the narrative, the markets will price in dovish rhetoric before the central bank has even spoken. This is when you can catch that trend easily or a lot earlier. What we mean by that is, for example, the Bank of England, the last meeting that we had at the Bank of England, they were saying about how inflation's really sticky still, and the growth is still pretty good. Therefore, we need to probably likely remain on the hold for longer. They push back on those cuts. Then after that meeting, we had inflation CPI component. Now we, just go back, that CPI that I put on the chart just before this one, trending lower, and GDP printed lower as well, or it revised down into negative territory. That was obviously after the central bank. Do you think now the central bank at the next meeting is going to be more dovish or hawkish? So they're going to be dovish. Therefore, you can just kind of see the thought process. Therefore, I'm going to have a much more bearish view on the currency going forward. And that's why it then leads me onto this, where GBP performance in the daily time frame has all printed lower. So as you can see, lower, 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 lower. Apart from this one, which is against the US dollar, which of course this is mainly as a function of the US rather than the UK outperformance. So you can kind of see it's trended lower, trended lower, trended lower, trended lower. We're actually a lot lower than where we are now, but that is just example of the performance of the pound. So like I mentioned, you're not going to be this is an example, but you don't want to be selling GBP XXX on everything. You have to do the same similar scenario for this, but GA downside makes more sense because obviously one, UK economic data is weak, and two, risk on mode from weaker US dollar is good for Australia. Similar, exactly the same framework for New Zealand, obviously very high beta. Canada as well had a little bit more of the data might suggest a bit more of a hawkish rhetoric recently. You could trade that divergence there. And Swissy as well, SMB is pretty much done. This is mainly as a function of weaker pound, which we're reflecting here. However, against the US dollar, you want to be more long it because of the Fed. And based on the markets are a little bit more, inclined to be selling US dollars. Also positioning as well. It's very, very stretched to the upside in terms of the US. So that's an example there. Now, this is just an example of other UK data that you can have a look at. This isn't all the ones you look at, by the way. This is just some examples. There are much more examples there for you. Then again, we've made videos on kind of sort of the main data you may want to look at. But firstly, services PMIs. So we're going to look at this. This is UK data, by the way. You're going to look at this and say, why is the pound trended lower? It's because of what the data has meant for the central bank at the next meeting perspective. And I'll just speak about that in just a moment. But this is just services PMIs. You're thinking, services PMIs have printed upwards. That's actually pretty good for the UK economy. Why am I going to be selling the pound? Unemployment rate is steady at 4.2% for a while. Consumer confidence has got better. Wage growth has fallen. Core inflation has fallen. Retail sales has been higher over the last couple of months. Now, you're probably looking at it as services are up, employment held steady, fine, consumer confidence is much better, retail sales is good. I want to be probably long the currency, not really, because remember, what is the theme? The theme is, or the theme of the market is, who's going to be cutting first and who's going to be more aggressively who's going to cut much more aggressively. So what do? You now look at data that will support the idea of who's going to cut first and who's going to cut more aggressively. Remember, the central bank has a dual mandate, so they look at price stability first, or they will generally look at price stability first. Not always, but generally they'll look at that first and then sort of the labour market. So if inflation is moving lower rapidly, which we're seeing here, as you can see here, core inflation 6.9, 6.2, 6.1, 5.7, 5.1. The central bank is much more likely to be much more dovish now. Wage growth, another example of inflationary data. wage growth has printed much lower fairly quickly over the last couple of months. It's 8.2 to 8.1, then 8% to 7.2%. So if this trend continues, the Bank of England is much more likely to be dovish going forward. So therefore, that's the reason why the pound has weakened pretty much against everybody. It's because the theme of the market at the moment is who's cutting first. So we look at data that will support the idea of cuts. Some of this data will support the idea of less need for cuts. For example, uptick in that services PMIs, steady unemployment rate, retail sales, pretty decent to be fair to you, and consumer confidence. But the way the markets are reacting at the moment is more on the inflation front. Eventually, they won't care about the inflation. They'll then look towards this other aspects. But it's important to also look at this as well, is because it will give you an idea of, okay, if this prints, like if you look up GBP versus the pound short during this time here, when we had services PMIs printed from here to here, so expansion territory above 50 to then below 50, we saw a massive sell-off in the pound. So it just gives you that is just an example of how the markets switch their bias, because now this supports the idea of cuts, less need for hikes, more need for cuts. Now in this example, we're seeing it slightly tick up fine, but we are seeing the main components of why the central bank would cut rates print much lower. This gives us ideas of what could happen in the future. This is what has happened. This is the facts. This is the potentials. Services PMIs are good because it gives you an idea of what could happen in the future, not necessarily what will happen. The central bank will react more to this main component. So the markets will look at this and say, okay, services PMI is printed high. Maybe inflation's less stickier, but it's not a given. It's not one-to-one correlation, by the way. But it is an idea of potential. Retail sales is good. Okay, consumer pockets are still pretty decent. Maybe the central bank will probably hold rates for higher, for longer, for example. So it's all about the reaction function, and I have made videos on that. But then again, you have to think about the theme. So that's really, really important here. So now here's just a case study. So we're looking at the USD in Q4 2023. The dollar has been an interesting mover throughout 2023. It's gone up, it's gone down, it's gone sideways. So it's more about kind of what's going to happen for us now in the future. And we're going to go over that. Now, the theme of the market is who's likely to cut more. The theme within the US is the soft landing scenario, non-recessionary, good for risk appetite. So risk appetite meaning sort of the stock market, higher Aussie dollar, US dollar, or higher AUD, higher New Zealand, for example. So those are the two themes at the moment. One, the main market theme is who's going to cut first. And then the theme at the moment within the US is about that soft landing scenario. Everyone who talks about the US is talking about soft landing or hard landing. That's clearly a theme. Like I've mentioned, to understand the theme is just to understand what is everyone talking about. That is it. So just looking at some of the data, GDP growth, 4.9%, the last figure I've taken it, December 2023 or late December 2023, revised down from 5.2%, previously 2.1% on a year-over-year basis. Inflation moved down from 3.7 to 3.2 to 3.1%. Interest rate expectations are markets bringing forward their views for cuts to March 2024. So we've seen a fairly large shift lower in inflation. We've seen GDP kind of being revised down slightly. Still pretty good, don't get me wrong. 4.9% is still pretty decent. But it's the direction of the market of that data is what the market kind of cares about. Eventually, you might come to a point where the markets compare the overall figures, but at the moment they care about that direction, and that's what we're trading. Remember, trade with what you know at the moment, and don't say, recession, let me buy the US dollar, let me sell the S&P. You're not going to buy. If you look at what's happened to the market, it's done completely opposite to that. So it's because the markets are more talking about the soft landing. The data is indicative of a soft landing scenario. Until we see it point net recessionary, fine, then we could be bullish the dollar because of risk off, bearish the equities in the near term. Fine, we agree with that. But at the moment, markets care about soft landing. Overall, US data isn't bad compared to other economies, but remember, the markets care about the direction the data is traveling. Themes give you better clues on what data to look at. The US markets are battling the hard landing recession versus the soft landing recession or non-recession environment. So far, the data is consistent with non-recessionary fears, which is bad for the dollar and good for risk appetite. So higher equities, risk currencies being bought like the AED, the NZDs, etc. So what we mean by that, remember, soft landing, non-recessionary. Well, GDP is pretty good. The labour market is still pretty good. However, inflation's moving very rapidly lower. So therefore, the central bank can cut now. Well, they're not going to cut, or they're not like, oh, the labour market's really weak, let me cut rates. They're actually like, oh, the labour market's still pretty good. Inflation moved low, we might as well cut rates, right? Because by them cutting rates then supports the economy even further, which is really good for them. So that's why the markets are battling the two themes at the moment. And they're understanding, okay, which one is happening at the moment? That's what we need to care about, is what is happening at the moment. And at the moment, it's more about the soft landing. So we just look at data that supports the soft landing scenario. It's as simple as that. Since people are talking about the soft landing scenario, inflation moves lower without causing a recession, we know we need to watch data that is consistent with a soft landing. We can watch labour market data to see if it isn't loosening too aggressively, and inflation or inflationary data is coming off nicely. If this continues to support the idea, we should continue to be bearish the dollar. Unless a hard landing scenario is beginning to materialize, we may need to switch our bias to being long dollar as a function of risk off and fears. So like I've mentioned, unless, that's the key word, unless it's beginning to materialize. So far it hasn't materialized. So the data in terms of like payrolls data, NFPs, GDP data, you've got other data out there like services PMIs, service components, because the US is mainly services based. In fact, pretty much almost the G10 is, pretty much everybody actually in G10 is services based. So you now watch very heavily on that services data. Now you add on to you look at other data that may support the idea of a recession or adds to the idea of a recession. You could also look at wages, look at could look at credit card debt if you wanted to. This is all indicative of sort of that hard landing scenario. So it's just a matter of just watching the data that the markets care about, essentially. You know, there are going to be certain data out there that people don't really care about. For example, in the UK, people don't really care about the import and export data at the moment. They will eventually, but as of right now, no, they don't. The theme of the market is about who's cutting first. So it's indicative of data who supports that cutting first scenario. Eventually, like I've mentioned, there's going to be an environment where people don't really care about the cutting environment now. They care more about what's the next theme. We'll know once we get there, but you can kind of get the gist. And then the next thing could be, let's say, whose growth is better. Now what we do is just watch the data within each economy that supports the growth idea of growth. So GDP data, labour market data, unemployment rate, retail sales, etc. If that's better in the UK than it is in Europe, Euro GBP sells, because that's the theme now and the markets are driving to that idea. So here's just some other examples of US data similar to what I've done with the UK, but services PMIs are up. Unemployment rate has ticked lower recently. Consumer confidence massively up, which is good. Wage growth did tick up as well, which is interesting. Core inflation has ticked lower. That's just the core component, by the way. And NFP has ticked slightly up as well. Now, you're probably thinking, okay, this should actually be bearish for the dollar. And we'll get into that in just a moment as well. But here's some US cross-asset, so cross-asset correlations. DXY, so the dollar index versus the US 2-year yield, so interest rate expectations. DXY versus the 10-year yield, or the 10-year expectation. To be fair to you, you can see here how it's correlated it pretty well as of recently. So what we mean by the cross-asset correlation perspective is just watching. Obviously, this is the bond market. So now you think, okay, what drives the bond market? It's also about interest rate expectations. So you now know if the bond market's trending lower, the currency is likely to weaken because it's following it. It's following it. It's obviously not going to happen all the time. For example, in this example here, where this traded up, the bond market traded up, but the currency weakened. Again, there's going to be reasons for that. But this is just a cross-asset correlation. And of course, the DXY versus the S&P 500, which is inverted. So if I did invert it, obviously this would be going higher. I just inverted it just so you can see it a bit easy on the chart. But what that means is the S&P obviously being a function of risk on, risk off, so risk sentiment. If the S&P is trending up, so if I didn't invert it, as I mentioned, this blue line would be cutting across the dollar. If the S&P is trending up, obviously, at the moment, because soft landing, non-recessionary fears. Soft landing scenario, higher equities, more cuts, good news, growth pretty good in the US still, inflation moving lower, all beautiful stuff. Now, obviously, from a cross-asset correlation, I've made videos on this, by the way, so, if you're a little bit confused at the moment, I have made videos on this. But obviously, higher stock market, good for risk current, good for risk asset or risk appetite, good for risk assets as well, like the Aussie dollar, and bad for the US dollar, which is obviously counter to that, which is mainly a risk off currency. Now, just also in terms of positioning, so USD positioning, so COT data, commitment of traders. This is just the commitment of traders. We, as traders, you want to be focused. I'm not going to go over a COT lesson today. I will make a video on that. But non-commercial is what you mainly want to be looking at. Commercial is people who hedge their currency views, that they tend to mainly be opposite to what happens from a non-commercial perspective. Commercial are people like farmers. So if they see the price of their, let's say, grain becoming weaker, for example, they will hedge that risk. So they will go sort of long futures, and then they'll hedge the risk out. Non-commercial, like banks, hedge funds, etc. Non-rept is like very, very small contracts. So retail traders, basically, not even worth looking at the red one or even the black one, to be fair to you. Mainly look at the blue one. That's what the markets care about. You can see at the moment, we had very high positioning, very stretched, 20,000 contracts long. And then we saw a massive shift lower recently. Why did they shift lower? Because of the data. So as traders, we want to be eyes on that data because it gives us those ideas on where the currency is going to be. Also, as well, this is just a more visual perspective here. Non-commercial is what we're going to focus on. You can see how they exited 12,000 contracts of longs. So by them basically taking profits on their longs and adding more contracts to shorts, which is indicative of lower currency, right? And as you can, obviously, we don't really look at the commercial one here. And then this is just another one that you could look at, which is asset managers and institutions and leveraged funds. So leveraged funds are mainly like hedge funds, people who take positions on leverage, basically. You can see both components exited more longs massively, especially this leveraged fund perspective, and then added more shorts, which is good for dollar weakness. Now, obviously, COT data is very useful. Don't get me wrong. I would use it as a way of understanding how stretched positioning is. But it lags what's already happened on the chart. That's the issue for me. It's already lagged. If you know what's happening fundamentally, you know what's already happened, you can understand what's likely to happen with COT data. So that's something just to note there. This is known as the flip when it trades below zero. Now, I have made a chart on here just to more visual for people who like a more visual chart. But this is the dollar index from around Q4 onwards. And I've just put little notes here. What's happened to the currency when it's weakened? This big sell-off happened because of downside surprise to NFP, wages, and a tick higher in unemployment rate. What is that indicative of? If NFP becomes in weaker than consensus, if wages come in weaker as well, and then unemployment rate rises, that's indicative of more cuts, isn't it? Inflation is coming in weaker, lower than consensus, adds to that support softer landing scenario. This did weaken, so NFP did come in weaker and a higher unemployment rate. You would think, that's technically recessionary. Not at the moment. Now, unless that really trends higher at a fairly pace, like unemployment rate really climbs higher, NFP comes in really aggressively lower, then that's non-recessionary, or that is recessionary, sorry. But at the moment, based on what we saw on, I think it was around the 3rd or the 4th of November, that didn't suggest a hard landing scenario or a recession. Inflation then coming lower again soft landing because the labour market is still pretty good. Although we did see some weakness here, not massive weakness. That was then indicative of a soft landing scenario. Bang, nice weakness, followed through. Then saw a little bit of a pullback there. We then saw a dovish Fed here. Bang, not pushing back on cuts, which is good news for the markets. We then saw a lower than expected GDP figures. Unemployment claims did get better than expected, which is soft landing. Bang, dollar weakness. Because now the markets are bringing forward their rate cut expectations, aren't they? They're like, inflation's trending lower. Your labour market's still pretty good. Okay, cool, that's soft landing scenario. Let's sell the dollar. And then we had core PCE coming in lower than consensus. But like I've mentioned here, in the Christmas period, likely suppressed the move there. And then we did see it follow through into sort of this week as well. So that's kind of how you get a fundamental bias. Again, it's going to take a lot of work. There's a lot of things to consider: cross-asset, hot data, other data on here as well. You can also look at, like I mentioned, all of the main components like GDP, the monetary policy. You're going to look at inflation and interest rates. But like I've mentioned, it is going to be difficult and it's not going to be easy. But if you are consistent with your learning curve, you will see the results. And it is going to take a lot of work, but you will eventually get used to it. Again, it's like learning technicals, right? It's really difficult at the start, really confusing. The more you did it, easier it became. It's as simple as that. So yeah, that's kind of how you get a fundamental bias on the margin. Look at your interest rates first, or there is no right or wrong answer, or right or wrong way of doing it. But get your GDP. What's the GDP? What's the trend of the GDP? What's the components of GDP? What's happening with that? Inflation. What's happening with inflation? Is it trending lower? Why is it trending lower? Interest rates, what's the interest rate expectation of the central bank? Is the market's pressing more cuts? Then look at, of course, other data as well that supports the idea of what's happening in the market. So soft landing scenario for the US is, okay, let's look at data that will support the soft landing scenario. So fairly decent labor market data, inflationary data pointing lower. Cool, that's all good news for weaker dollar. Pullback, sell, pullback, sell, pullback, sell. That's all you're doing. So now, in terms of applying technical analysis, this is how we do it. Now, this is going to be a really, really quick bit because it's not difficult. But applying technical analysis is very simple. As you have already done the majority of the work, all you're doing is just looking for an entry and a stop loss. And the stop loss is your risk, of course. If your fundamentals tells you that you want to be long the Aussie dollar and short the US dollar based on the totality of the data, the themes, etc., why would you ever consider selling AUD USD? You don't. You know, you've done all the work. You've said, okay, I want to be long AUD USD because of this. I want to be short the dollar because of this. Cool, AUD USD upside. Cool, fine. Once we see a pullback, we want to get long. Do not even consider looking for supply candles to sell. Why are you going to do that? Makes no sense to me. Now, you can sell against your fundamental trend if it's a tactical trade. So watch the short to long-term theme videos. Unless it's a tactical play, fine. But just because the trend has moved up doesn't mean you now need to sell it as a hedge. I would only sell it as a hedge unless it's tactical. So I want to see a reason why a pullback happens. Pullback happens for a reason. It doesn't happen just because it wants to happen. It will generally happen because of a reason. Now, unless positioning is extremely stretched, people are just taking profits, fine. But a pullback doesn't happen because it needs to happen. Pullbacks happen because of near-term fundamentals. So that's when you can catch that near-term little in and out sort of trade there. But every technical strategy works in their own way. For example, markets around Q3, Q4 this year was very mechanical in their nature. What I mean by that is bouncing off whole numbers and off support and resistance. So people's going to laugh at that. But in reality, it works. We haven't seen many order blocks of supply and demand being respected. We know institutions hardly put any emphasis on technical analysis. So why should we? You know, that if people bang on about trading like a bank, if you're not even looking at what banks are doing, if you've never spoken to somebody, if you've never even looked at their charts, how could you argue the fact that they don't trade like this? We've spoken to them. We've looked at what their analysis will look like. That's based on what I've seen already, based on what I've heard, based on what we've spoken to. So, you know, if it's like you saying a fact when you've not even fact checked it, if that makes sense. You need to actually, if you actually go out and look at it, you think, actually, you know what, this is true. Everything I've learned at the moment is kind of more marketing, to be honest with you. But HSBC, this is how they trade generally. HSBC uses whole numbers like 125 on GU or 110 on euro dollar and areas or regions to get in. So they'll say anywhere, we're bearish, let's say, for example, euro dollar. Anywhere between 111 and 112, we're looking to get in. Cool. They might use another, I know they also do look at moving averages. Their entire technical strategy was on one of the docs. I will try and get that if you want that. But their entire technical strategy was unlocked. They looked at positioning. They looked at moving averages. They then looked at central bank rhetoric, I think it was before one of them. This was a while back. If you want to get it, I will find it. It's in the Discord somewhere. Bank of America uses support and resistance with also a bit of patterns. So like a flag and then getting long. Remember, all your technical doing is just looking for an entry and then your exit and then also a bit of stop loss. That is it. You're not saying, oh, it's trending up, I have to be buying, or it's breaking the structure, pulling back into this order block, now let me sell it. No, you're not doing that. RBC Capital Markets uses support and resistance. This clearly tells you that there's more to trading than just drawing some lines on the chart. Everybody has their own way of doing it. Every trader is different in terms of technical analysis. Everyone will look at it slightly differently. But the fundamentals doesn't really lie. It's facts. It's right there. So if you can interpret that correctly, you're on your way there, essentially. So now let's look on the charts to see how we apply your fundamental bias to technical analysis. So let's have a little look how we can apply our fundamental views. So for example, at the moment, we know based on our sort of perspective is Euro dollar longs, GU longs, AU longs, USD JPY shorts. This is all given that what we've spoken about in terms of on the breakdowns, etc., continues. Again, I can talk about it now and that can completely switch next week. So that's why we always keep up to date with what's happening. But based on what we know at the moment, Aussie dollar, US dollar longs makes a lot of sense. GU longs makes a lot of sense as well. USD JPY shorts, of course, as a function of the Bank of Japan as well, turning a bit more hawkish. So based on that, we know our direction. So let's start off with AUD USD, and I will draw it out first on the chart, and then we'll get onto the technicals. So we know, based on the fundamentals, which is inflationary data in the US is moving lower, which is creating that soft landing scenario. The labor market isn't really loosening too aggressively, and that is good because, again, if it weakened too much, basically, that would be recessionary, which we haven't seen that already. So the market's like, okay, cool, we're seeing that. We're not seeing it recessionary fears at the moment, or data that would be indicative of recessionary fears. Okay, cool. Now let's just be bearish the dollar, which everyone has done. Now, what we do is simply only look for dollar shorts. And as a function of weaker US dollar and higher equity markets from a cross-asset correlation, stock markets higher is good for Australian dollars because of risk-on environment that is naturally created there. We now know our fundamental bias. And of course, in terms of like rate cuts, etc., there's less cuts priced in the RBA versus the Fed. So there's a divergence there as well. Now, we know we only want to look for longs. We don't look for shorts. That's the biggest thing we can do. If we're fundamentally long, do not look for shorts at all. Only look for longs. Wait for the pullback, get into a long. Wait for the pullback, get into a long until something changes. That's when we can change our view. Maybe from a near-term tactical plan, fine. But only look for longs. So now that we know our bias, based on what I've just spoken about, what do we do on the chart? So let's say the chart's done this. Trending lower, trending lower, trending lower. This is obviously the last significant high. Lower high, lower, or lower high, lower low, lower high, lower low. We then see this happen. So there's a couple of ways you can do it. There's two ways I would kind of look at. Number one is a bit more of an aggressive approach. But this is number one. So let's say the trend's done this. We then see this. You could look at an order block here or support or hold number. Like I've mentioned, every technical strategy works. And then get long. Because you're long anyway from a fundamentals, right? Now you can get long and your target's going to be higher because we're swinging this trade. Now, in terms of a lower time frame, you can always, if you're long, you know you want to markets want to be more long, you can get in on those lower time frame moves, get in and out quickly, right? Whereas we're going to be holding it, do this, holding it, do this. Whereas you can always get in and out on the moves higher, in and out on the moves higher, wait, etc. You know, you can apply it on all time frames. But this is a more aggressive approach where you just look to your left on the high time frame and that's your entry. Another way you can do it is mark out your level anyway. Don't enter, but wait for structural breaks, which is that. Wait for the pullback, then get into an area and then get long. So there's one aggressive approach here. You might get slightly better, a better entry, but run the risk of maybe getting stopped at. Maybe the market wants to trade a little bit lower into this level, because we don't know where the market is going to react, right? Nobody knows where they're going to react. That's where technical traders are a little bit interesting, because, again, don't be going wrong, I know very successful technical traders, and it definitely works. But fundamentals applies that probability, right? Trading is all about probabilities. It's about increasing your probability. This massively increases your probability of winning. So we don't know where the market's going to react from. So this is why that's more of an aggressive reaction or aggressive approach to the market. My preference is a bit of both. I prefer more on this perspective of waiting for a break and then getting in, just so I know that the markets truly want to reverse from that region. And then we can look at an order block or a support level or whatever technical strategy you want to look. There's no right or wrong answer here. So there's two ways you could do it, either from there, order block, support level, whatever, get long, hold it, or wait for a structural break, lower high, lower low, lower high, lower low, pullback or break a structure there, wait for the pullback, get long there, bang, look for upside moves. That's another way. So there's two ways there, absolutely no problem. So now that we know, let me just do this. Now that we know kind of a framework from a chart perspective, let's have an application on chart. So obviously for us, we are long from these levels down here anyway. So we're going to just, obviously this is hindsight trading. So we're looking at already what's happened. But if I just go this. So we now know, based on these functions here, where is the 3rd of November? There. So at this stage here, this is when we turn tactically bearish to the dollar, because of we saw NFP coming in weaker, we saw unemployment rate rise. That's all indicative of more need for cuts. Cool. And then we had inflation here coming in much weaker. Amazing. So if we turn bearish here, obviously we were already we were stretched here. Cool. We always wait for the pullback. We don't just normally get in. We generally wait for the pullback. So we then do, so if I just replay it backwards. Did we see any structural shifts and structural breaks here? Yes or no? We did, here. So this is the last high, right? Before it made the low. So the lower high, lower low. So that's the last significant move here. That isn't a major structure, because of this is the last structural high here. This is the most important one. The lower high on a downtrend is the most important one. For a structural break, of course. So now we saw that, especially closing on the daily time frame. That's very, very cool as well. Now what do we do? So you can kind of see here, we've done this on the breakdowns as well. So you can have a look at the technicals as well, and go back and go into history and watch it. Everything we've done since the start of BMO has all been recorded. So if you want to hold us to account to anything, you can go back and watch them. Just marking out this as well. So start on the high time frame, work our way down. So that's the daily order block. So is there anything on the weekly? Nope. Remember, we switched our bias here, right, to fundamentally being long or fundamentally being short the dollar. As a result, we were long Aussie dollar, US dollar as a function of risk on, risk off. Cool. We then went to the daily. We start on the weekly, go to the daily, mark at a level here. Is there any way we can refine that better? So there is a level here on that 8 hour. So if I just move that box slightly lower into the 8 hour, just to encompass that as well. 6 hour, 4 hour. Not that I'm seeing there. So now that we marked out this level here, that's where we were looking to get long. Now let's just wait. Let me just go forward slightly. Where do you think the most significant high is on here? So if I just go forward. We saw some near-term breaks there. We then saw the major structural shift there. We then saw it pull back slightly. And then it trended up again. So in this example, obviously this is the major structural shift here. We then saw a pullback. Now, regardless if it's a larger or shallow pullback, we did see it pull back slightly. So we saw that massive rally here. Get pullback. You could also get in on a 2-candle swing. So that is another way of getting into a position. Drew has made a video on that, by the way. So please go into the technical aspect of the website. But that's another entry strategy for you, is 2-candle swing. Just see which one works for you, which you prefer. Again, it's completely personal here. But we need to know that we only want to be looking for long positions at the moment. Now, we then saw the sort of near-term little moves here. We then saw, well, that's lower time frame break structure there. We then saw the major structural shift was technically there. So we then broke that there. We then saw a tiny pullback. I don't know, what is that? Is that like a 50, 20, whatever that other one up there is? Very shallow pullback. When shallow pullbacks tend to happen, they do tend to aggressively move higher as well. But the main story, we saw it regardless. So I go on the daily time frame. We then saw the pullback there, and then we're back up to here. So let me just go back to this one where we saw a pullback. I didn't get in again, a little bit annoyed, but we had some regions here for us to monitor. So number one, we have this massive weekly order block here. Obviously, we don't want to enter there because you're not going to get risk to reward, good risk to reward. So fine, we'll just adjust that. Saw that daily little region there. So the daily region is here for you to potentially get in. Just trying to see if I can refine that a bit better. Cool, doesn't look like it. So a little bit of a mover away from there. Now, you can even see it within that. So if I go on the lower time frame, or that 1 hourly, we saw a little structural shift here on the 1 hour, where this made the high, lower low, lower high, lower low, break a structure right there. We pulled back. You could have get long here, and then you're swinging it, and of course your stop loss would have likely have been below the low. So you can kind of see there's an example of two where you could have just entered at the order block. Cool. Obviously your stop might have been slightly wider, and then you could have just held that move. Or if you want to be a bit more conservative, in this example, wait for the structural shift which happened here, wait for the pullback, stop loss below the low, hold, and then you just held it. So there's just two examples of applying it to your technical chart is the Aussie dollar, US dollar. Remember, we're fundamentally long, right? We're not looking for short. So what I mean by that is you don't go, let me look to my left and say, there's a little 12-hour order block right here. Let me sell Aussie dollar, US dollar. Why would you do that? There's no reason for you. Remember, we're fundamental traders, right? We need reasons to get into a position. If there's no reason for us to get in, why are we going to enter? Remember, our rules state we only want to get in when we see reasons. At this time, there was no reason. Why am I going to sell Aussie dollar, US dollar when I'm fundamentally long? Unless there's a tactical play, fine. But nothing tactically happened here for me to get in. So don't even look for sells until you see a reason. And of course, you'll know that reason by just watching the fundamentals, etc., etc. So you can kind of see the thought process. So the similar scenario here. So let's go on to actual live charts now. Go on the daily time frame, do exactly the same framework. So let me just remove this. So there's a daily order block here. So just mark out your daily order blocks. See which one holds, because you don't know which one is going to hold, right? Nobody knows. So what we're doing is just monitoring areas which seems relatively decent to monitor. I'm just a little bit cautious here because we are pretty stretched to the upside. Now, I know some people like to trade imbalances. I personally don't, just because I've never seen success with it. But I'm not arguing the fact that it doesn't work. I just prefer not to use it. I'll mark it out anyway, just so that people can come back to this. Let me see if there's any 8-hour order blocks. I'm just trying to see if there's anything down there, which I can't see at the moment. 12, 8 daily. It's a little daily down there. You can mark that out for sure. So now we have a couple of areas. All we're doing is just watching structure at those levels. So we know we want to get long. It's just a matter of watching the structure to see, is it actually happening or not? Technicals gives you that entry point and your stop on your risk, which is your stop loss. That is it. It doesn't give you the direction. Remember, fundamentals drives the technicals. What's happening here is what's happened all fundamentally. So if you know what's happening fundamentally, you know where the chart's going to be on a 1, 3, 6, 9, 12 month horizon, right? So that's how you do it. And you do exactly the same framework. So going like Euro USD, for example. So if I go on here, start on the weekly, you can kind of see just missed that weekly. There's probably a lower time frame order block within that. But nevertheless, go on the daily. If I replay that backwards, let's say here, it's just a random level, by the way. October, we were still technically bullish the dollar at that stage because there's no reason for us not to be bearish the dollar now. We then saw the reason there when we saw NFP coming in much weaker on the 3rd. Bang. We then saw some nice moves higher, big bullish moves. Cool, amazing. As you can see there, it's not really strong structural breaks at all there. Now what do we do? So if we know we now want to be fundamentally long Aussie dollar, euro dollar, what do we do? So now we only look for longs, don't we? So this is why it cuts out all of the noise, because I know people who would like sell at this level here. Well, if you did, what do you think would have happened? Markets need reasons for pullbacks. Markets need reasons to go short. Markets need reasons to go long. Why do you think that was breached? People would blame the banks for taking them out. Why are you selling? 1, against the trend, 2, against the fundamental trend. So only look for buys. We're only looking for buys unless it's a tactical play, then fine. But don't look for sales until otherwise. That's kind of how I would approach it. Again, you'll find a way of what works for you in terms of your thought process. But as long as we get the same end point, which is a fundamental view of at the moment being long euro dollar, then that's all we're doing. And that's all that matters really. So where was the 3rd of November? Just let me find that. There we go. Cool. Go back slightly more. Just don't want. There we go. So starting to go on the daily. Market order blocks on the daily. There's one massively down there. There's a 8-hour down there. That would have been the ideal perspective because that did also take out these lows down here. As you can see, more lows getting taken out. Cool. That would have been the ideal situation, but it didn't trade down into that. Go down to the 6. I just want to see if there's anything else on here that would have been of interest to me. So, bang, bang. Let's see if there's anything. A lot of imbalance there, to be fair to you. I know some people like to trade that, which it does seem like it respected, actually, in this example. Yeah, 50% of the imbalance is what people look at. Cool. You would have got in there. I mean, you were fundamentally holding this up, right? I did enter pre NFP and wages, but that was mainly as a function of weaker data we did see prior to that. There were way you could do that only if you're experienced, though. If you know kind of what's happening, I wouldn't recommend it as a new person. So the best way to do it at the moment is to just watch this, wait for breaks, wait for pullbacks, wait for your regions to get in. Now, I just want to see if there's any other ways. I only entered one long. I want to see if there's anything else that I missed on this major pullback here. Just missed it there. Daily order block. 12, 8. So you can kind of see in this example we're not seeing many order blocks being hit. So this is why you need to have an understanding of different trades, because I know some people would have longed it because of that support level there. So who's right and who's wrong? You see what I mean? So this is why I don't get why people like to argue about one strategy being right. Based on that logic, pre-2019, when this, the order block strategy really boomed, everybody lost money based on that logic, when in reality, obviously, that's not the case. So this is why it's important to have every strategy in your mind, broadly understand how everything works, and then go from there. But as you can see, that was more of a support level trade. Let's look at GU. I think it's a similar price action, actually, to euro dollar. Yeah. Similar scenario. We saw massive moves higher on NFP, basically suggesting more need for cuts. We then saw it pull back into this level, actually, this little tiny 8-hour. I want to see if I can refine that, though. Four-hour. So it's kind of within that 4-hour. As you can see, I know people like to mark out the highs and the lows of the box, which is also fine. I have noticed recently, it's actually around the middle of the year, where the markets were pinging more off the wick rather than the open, which is, it happens, it is what it is. So you can mark out the entire high and low of that candle. And then we saw it pump a bit. I just want to see if there's anything within that. Yeah, it's all within that level. Cool. And then we moved higher. Now, that's one of the aggressive approach. Obviously, we're hindsight, right? So it's a bit different to doing it on the live. But I just wanted to just go over kind of our positioning behind that. Now, that happened there. Do we want to wait for structural breaks? Of course we do. Where's the structural break? This lower time frame move here. Did we see any breaks of structures? Bang, we did. Did we see any? Actually, we did. In this example here, we didn't see a larger pullback. Now, you could have got in on this little moves down here, but then again, it's up to kind of how you like to trade it. If you feel like you could have got in, fine. We did have that little 4-5-minute candle there on the lower time frame as a pullback opportunity. You could have just entered market execution, stop loss below the low, of course. There's a multitude of ways of how people want to get in. I just want to give you some frameworks of 2 candle swing, which is 2 bullish consecutive 1 hourly candles. As I've mentioned, Drew has made a video on that. 2, entering on that sort of higher time frame, looking to your left perspective of aggressive play. Like, for example, if you bought there, you would have went into a little bit of drawdown, which is why I've said it's a little bit aggressive. Or 3, you could wait for that breaker structure here, wait for the pullback, regardless if it's short or a bit of a deeper pullback. Get long, stop loss below the low anyway, and then we look to swing higher. Now, that's the 3 ways I would do it. Is 2 candle swing. I also use that because it depends on how confident I am in the chart. So if I'm really confident in terms of the probability of the setup playing out, then I might enter on a 2 candle swing. I might enter just on the left sort of candle there. I'll have to see how much risk I want to put into that trade. Or if I'm a little bit conservative, I just want to make sure that this is the right opportunity for us. Wait for that break, wait for the pullback, get in, and then we hold. Now, I've made a video on how we do targets already. What we're doing here is just simply looking to our left and aiming for the highs. So the high was there, the high was there, the high is here, the high is here, the high is here. That is it, because we're swinging these trades, right? And then that high got hit, that high got hit, that high got hit. So you can kind of see it respects those highs. But yeah, that's how you apply your technicals. As simply as such as you get your fundamental bias first, you then apply it to your technicals. So if you're only short dollars, or you're long Aussie dollar, or you're short Euro Aussie, or you're short USD JPY, you only look for shorts unless it's tactical. So you might go tactically long because if something's happened. If something hasn't happened, then there's no reason for you to get. This is when you're just guessing that the pullback's going to happen. This is why sometimes with a lot of technical traders is they're constantly getting stopped out before they get in, is because they're guessing where a chart is going to reverse rather than having any understanding if it is actually going to reverse or not. So yeah, like I've mentioned, have your fundamental bias first, then only run with that bias. So if you're only long Aussie dollar, US dollar, only look for longs. If you're long Euro dollar, only look for longs. If you're short USD CAD, only look for shorts. Wait for the pullback, get in. Wait for the pullback, get in. Don't go sell, buy, because you are going to increase your probability of losing on the buys because there's no reason for the markets to go long, if that makes sense. So that is it for today's video. Hopefully I've given you a good framework to work with. Like I've mentioned, there are going to be ways of you doing it. So some people like to do Excel spreadsheets. Some people like to write on the Word document. Some people like to physically write it down. There is no right or wrong answer here. It just depends on what you prefer to use. But overall, we should get the fundamental bias regardless of which way we're doing it. We should get the same fundamental bias. Remember, facts don't lie. The facts are on the data. The chart reflects what's happening fundamentally. So those are some points for you to take away today. So that is it for today's video. And I do hope that you enjoy the video series. Again, this is the top video. And then everything below that is kind of what you will be learning today. So if you are a little bit confused, don't get me wrong. I did also get confused at the start. but it takes time and it takes effort, and I'm sure you're up for it. So that's it for today's video. I will see you in the next one. Take care.